Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Lorne, great to be able to catch up with you. It's been certainly a while, but our viewers know you very well. So thanks for being with us.
I appreciate coming here, Kat. It's great to see you again.
Thank you. It is definitely fun to see people that we've seen for 10 years, right? And
For sure.
even though we're not together, we can still at least see each other and talk, which is great too, because I love this kind of longer format as we think about investing, your outlook right now. And also, your focus is more of a value investor and also looking for good companies with dividends, because I think that's what a lot of people are looking for right now. So why don't we kind of just start big picture in terms of whether or not you're bullish or bearish? It seems right now in May the 4th that it's got a bit of a sell in May and go away, but then there's also a lot of potential tailwinds to the markets over the next couple of years. So where do you stand?
So first of all, from an economic viewpoint, Catherine, I mean, of course, things are incredibly bright. By the end of the year, the vaccine will have been rolled out across the Western world. People will be getting back to where they were before to some degree. And consumers, everybody was worried before COVID about consumer debt. Now the savings rate in North America is at a record high, consumer savings. So consumers are desperate to go on vacation, go to restaurants and spend money. Governments are still priming the pump. So you've got consumer spending ready to roll, tons of government money there. So from an economic standpoint, things look really, really bright. From a valuation standpoint, low interest rates have driven the world for the last number of years. Valuations are certainly not as cheap as they've been historically, but investors are looking for yield. That being said, as I tell clients, we're not buying the stock market, we're buying individual businesses, and so there are still great pockets of value. So as long as one has a 5-year time horizon, we ask ourselves, can the stocks we buy deliver a 10% annualized return? And otherwise, we're not going to buy them. So we do see value and are bullish over that term. But I have to say, of course, as I tell clients, as much as we think we'll have a good return, you own stocks, your portfolio is going to fall several times between now and the next 5 years. And it's like last March. You own equities, you need to be ready for those times and certainly not panic. And if there was any lesson from a year ago at this time, if you own good companies, just ride it through.
Mm-hmm. And is that exactly what you did, or did you?
So we actually had a fair sized cash position. We actually wrote an email to our clients on March 23rd of last year, saying we have no idea where this is going, but we've been sitting with this cash position, and if we don't spend it now, we'll never spend it. And we listed a whole bunch of businesses we were buying, but our focus was on buying the best of the best, because we said if this recession goes on longer than one might anticipate, we at least want to have companies that are going to be around for the long haul. So that's exactly, we didn't hesitate. I have to say the team did a great job.
And Lorne, when you say that consumer savings is at a 50-year high, that's great in terms of pent-up demand. Just a couple questions that are going to follow this. But we also know that, government printing of money is at an all-time high as well. And when I speak to fixed income investors, one of their biggest concern is that the next crisis will actually be a sovereign debt crisis. Now, that might be years and years away. Maybe you're thinking about that too. But for right now, like how does that not, or where does it weigh in on your thinking about the equity markets and the bullish outlook?
So I think we have to separate two things, Catherine. In terms of sovereign debt, there's a big difference between developed market debt and emerging market debt. So listen. First of all, as a chart we put out from Office of Management and Budget, which is, U.S. government debt is, of course, at record levels. But hey, this money was raised at basically 1% for 10 or more years. So the interest burden on the U.S. economy is actually declining. It's actually in pretty good shape. And the best friend of debtors is inflation. So if we get some inflation, the money you borrowed last year, you have less to pay back this year in real terms. So we're not at all worried about a sovereign debt default. That being said, as I say, in Argentina, I think they've defaulted 4 times during my career. And there's room for other countries to run into that. We're not worried about that. Governments will, the budget deficits are going to come down around the world over the next few years, that's for sure. But it's not a huge concern. And when I say we're bullish on those parts of the stock market that still represent good value under any market conditions, and not bullish on those stocks which are factoring in phenomenal growth for the next 5 years. We did do in our last letter, Catherine just published, we went back, when's the last time we had high inflation? It was, of course, the early 80s. So we said, what happens if you bought the stock market, the S&P 500 in 1977? You held it through inflation that went from 6% in 78 to 13% plus in 81, 9% by 83. Your 10-year return, buying it before and holding it, would have beaten inflation by 8% a year. It was a 14% annual return. The reality is companies, when their input costs go up, they simply raise their prices. We own Diageo. They make Johnny Walker Scotch among 1,000 other brands. But if their input costs go up, they're just going to raise the price, make the same margin, their profits will grow. And so equities and real estate and other hard assets tend to be a fantastic hedge against inflation. Whereas government bonds, of course, get decimated during inflationary times. So would we be owning long-term bonds if we were bond investors today? Absolutely not.
Right.
Too much risk and minimal return.
Yeah. And so when we think about, when you're talking about the value-oriented areas of the market, with the run-up in the overall markets, people are saying, look, it's hard to find value. And if it is values, is there a lot of risk in that value? Is it a value trap, in other words? So let's talk we can do geographic first. Maybe that's a good way to start in terms of where you're really placing your bets. What does that look like?
Sure. So first of all, we were never, huge investors in Canada until about a little over a year ago. And so we certainly have a Canadian allocation. First of all, the dividend yield in Canada, because of the underperformance of Canadian equities for a decade, we're getting an average dividend of 3.5%. Canadian bank stocks still offer excellent value from a credit perspective. They're in fantastic shape and trading for maybe 12 to 13 times earnings, somewhere in that bailiwick, 3.5% dividend yield. Telcos, even though there is minimal growth there at the present time, as Canadians, we pay among the highest wireless rates in the world. And so, Bell, TELUS keep on raising their dividends. You're talking about a 5 to 6% dividend yield. And, it's the only place in the world we have retailers. We have Dollarama as an example, because there's no overlap with Amazon. So there's value in Canada. So we're not investors in oil and gas or mining from that perspective, though. An overlooked market has been the UK. So we own a couple of UK companies. With the whole Brexit, thing happening, there are pockets of value in the UK. Home builder named Redrow as an example. And then, elsewhere in the world, financials, we see, in the US and in Canada, great value. Financials lagged over the last number of years up until recently. And a rising interest rates, and specifically a steepening yield curve, is extremely bullish for insurance companies and bank stocks. So, there are opportunities, and healthcare has been a bit of a laggard as well, and we see some opportunities there. So we see opportunities, but not in Tesla as an example.
Right. That's not quite your style.
No.
And I actually want to divert for 1 second and talk about that, so that investors understand, or viewers understand that there are investors who have or are big believers in value investing or growth investing or GARP, which is growth at a reasonable price. Maybe just describe in your words what a value investor means, and maybe even why that's your choice versus growth.
Sure. So first of all, I find value and growth are, separated as two different boxes. So for us, value relates to what price we're paying for the earnings growth we're getting. So we own Alphabet, which is Google, which would be considered a growth stock. We own Microsoft, which would be considered a growth stock. For us, they're value stocks because when we look at the price we're paying, the moats around these businesses and what we anticipate their earnings growth to be, for us, these are every bit as much value stocks as Allstate and Royal Bank are for us. But the market has historically said, okay, growth stocks tend to be those techie stocks or, other stocks with really quick growth rates. And so you're paying a big multiple for them, where the traditional, Ben Graham value investor was buying, assets at less than book value. But the reality is, value really is, am I getting a good price for the business I'm buying? And so, like I said, within our value mix is Google and Microsoft, but also Royal Bank and Allstate.
Understood. And Lorne, value at the end of the day has been out of favor for a very long time as a style of investing. And so because of that, there's actually not a lot of value investors out there like there were 20 years ago. Everybody's kind of moved to that growth or maybe small cap or black box or, what have you. In institutional equity sales, I covered all these types of accounts. So, and with that, if there's fewer value investors, that means there's really less money chasing some of those stocks. Not that that's the reason to invest or not invest, but it does factor into the return performance. So maybe just talk a little bit about that, because that's been hard for some value investors, and that's why we don't have as many. It was easier to go growth.
Sure, and I think Warren Buffett figured this out quite a while ago. But value and buying things as I'm getting a discount to book value. There's a lot of great companies where book value is not a great indicator, a good metric. So I would certainly put any software company into that bucket, like Microsoft, a company like Google, where the traditional book value metric is not really relevant. And so investors that are sticking to that pure value strategy are missing out on large parts of the market. Whereas, so that's been one of the reasons for their performance. You've missed a whole bunch of companies that have revolutionized our economy, that are great businesses and who have real earnings and cash flow. And so certainly that sector has been, that area, called value investing traditionally has been a laggard. I think more and more over time, investors learn to value a Microsoft, an Alphabet, a Cisco, companies that would not normally be traditionally considered value stocks, but if you're buying a stream of earnings at a cheap enough price, that is value. And so also a lot of value stocks, oil and gas used to be a large part of the economy, a large part of the markets. The mining companies, they are shrinking as a percentage of the market as a whole. So I don't, investors that are sticking to those types of sectors and strategies may find themselves missing out on which companies are growing in our economy. And it's like Tesla might be a value stock at $100, but for us, not a value stock at $600. Just as an example, it's a function of price.
Right. And so that, people understand, because I think what I'm trying to also achieve in these conversations is to, appeal to our current and old viewers, but also really try to help people understand and feel comfortable getting into the market. With that, you need knowledge. Why is it that price to book doesn't work for a Google or a Microsoft? We need to describe that.
Sure. So traditionally, a company might make an acquisition, okay? And if an oil and gas company, for example, buys an oil field, then they might pay $1 billion for it. As long as that oil field actually has the amount of oil in, that book value will remain stable. It might decline over time slightly, as they pull the oil out of the ground, but it's a pretty good metric, which relates to the asset value of the business. Whereas a Microsoft, when they bought LinkedIn as a specific example and paid a fair bit of money for it at the time, there were no hard assets there. They were simply buying what we call goodwill, which is really immeasurable. It's just their assumption of what the earnings will be. So they paid a massive multiple of the actual book value because there might have been a small amount of cash there and not much else in that company. So from a book value basis, it looked like a crazy acquisition that they're paying a huge valuation for. In retrospect, what has happened is Microsoft figured out that forget about the assets we're buying a platform. And Microsoft has been able to increase the ad revenues and various other revenues from buying LinkedIn. So on a book value basis, LinkedIn would have made no sense to a traditional value investor, but someone who is looking at the stream of earnings that could be generated said, hang on a second, this is actually a great acquisition, which it's turning out to be.
Right. And I appreciate that. And so bottom line, it's really about the not the tax treatment, but the income statement treatment for various acquisitions.
Correct. You're buying.
It's a function of accounting, really.
Exactly. You're buying an income stream. And Microsoft felt really comfortable that they could generate a great income stream. What are the hard assets for a LinkedIn? There's no really hard assets. It's a platform, but the hard assets are some computers and I guess some desks and things like that. It's the fact that they've got a lot of eyeballs on their platform, and a lot of us are using it for various different things. Everything from hiring people, they figured all kinds of ways to generate revenues through LinkedIn, and they're growing that business at a pretty hefty rate, I have to say. But on a book value basis, you'd never have bought it.
They could make eyeballs hard assets.
Exactly, and that is, that's really the monetization of those platforms are the number of users that use it, and then they figure out ways to sell advertising and other things.
Yeah. Yeah. So I just want to point that out because, depending on, and everybody needs to know this, depending on the sector, whether it's retail, oil and gas, technology, whatever it is, there are different metrics that matter to the stock price performance, and there are different valuation metrics that people care about and ones that they don't. So that's why I'm kind of just spending a little bit more time than we would if we were on linear TV. So I think that's just important for people to learn.
That is really, actually, that's a great point you made. Different metrics for different industries.
Yeah, that move the stocks. It's just, and that affect the companies and move the stocks and have different appeals. And that's why, Lorne, people who are new to this, you have to know the rules of the game. And that's why you're the portfolio manager, but you've got a team of analysts that help support you in understanding those different industries and sub-industries and knowing what matters and what doesn't. Not everything matters for all industries. It's so critical to getting the stock right. So Lorne, you said that you are now more interested in investing in Canada. You talked a little bit about owning in the UK and a few stocks in the United States, but you're very bottoms up stock specific. So am I wrong then to ask you geographically, is there a percentage you want to be in certain areas or not?
No, we don't have a specific percentage. Our global strategy is roughly 50% US and a chunk in Europe. Japan has done well. We used to have a large weighting in Japan. That weighting has shrunk because a lot of the value stocks we bought back in the day realized their value and we moved on. We see value in Europe, I have to say, but in specific companies, everything on the healthcare field. One great global healthcare company is Philips. If you walk into the Dutch company, if you walk into any hospital room, I hope no one does, but if you have to, you'll see so much equipment around the patients is Philips diagnostic equipment and the like. They've done a great job. Sanofi, the French pharma company, also trading at a very reasonable valuation, good dividend growth and earnings growth. No big tie to any one drug, driving the company. Always an issue with pharma. And so, we do see value, in different sectors. Again, even in Europe, financials, ING, for example, the Dutch bank, purely retail. I've always said in two countries you never read about, the Netherlands and Belgium. Two boring companies with, very stable economies. So there are pockets of value, but, we've also been more active, Catherine, in the last 18 months than we've been in the last 5 years. With all the volatility, we have to be very cognizant that if stocks really hit our valuation targets, you have to ask yourself, if I bought them when they were cheap because I thought they'd reach fair value, if they go past fair value, why do I still hold them?
Right.
So we've been more active than we have been in a long time.
And staying with healthcare for a second here, let's talk about a few of the names that you like. CVS, so drug retailer, but of course has a healthcare component to it, with the pharmacy. Huge. To what degree?
Half the business, really, the earnings are coming from other sectors, other parts of what they do, the pharmacy benefits management part. Also, we like pharmacy in general because and we're seeing it in the States now and in Canada as well with the COVID vaccine rollout. The cheapest way to get these things out to people is not to have them go to hospitals.
When we think about the Walgreens and CVS's of the world, your interest in this, Lorne, is really thinking about pharmacies being a medical delivery situation.
Sure.
Location.
And we're seeing it in Canada as well, with people going to pharmacies now for their COVID vaccine. It's way cheaper for the system to send people to a pharmacy where the system is already in place and the government's not paying for the infrastructure than to have them go to hospitals. Pharmacies love it for the same reason they love having the post office in the back, because it brings people into the store and then they go to the back and, hopefully pick up a few items along the way, and also get paid for this. So it's a win-win for our government medical system, which is, over spending so much money on healthcare. In Canada, the provinces are spending 35 to 40% of their budgets on healthcare. And a big win for the pharmacies as well. So we expect to see over time pharmacies benefit from increasing healthcare rolled out through pharmacies. It'll be blood tests and taking your blood pressure and all kinds of things, which can easily be done in a pharmacy at minimal cost to the pharmacy itself. So it's we like pharmacy.
And Lorne, why CVS versus Walgreens? Like when I think back to my William Blair days when I was a junior equity research analyst, Walgreens was always the kind of best in class first choice. You often saw Walgreens perform very well. CVS was always playing a catch-up trade, and the stock was better on a value perspective because of that reason. So walk us through why like a CVS versus a Walgreens.
Sure. So Walgreens has stuck with the pharmacy only model, and they bought Boots in the UK, they paid a large price for that. And it's not looking like it was a fantastic acquisition for them in terms of the price they paid. Whereas CVS is going in a different direction to become a vertically integrated healthcare provider. So if you can imagine one of their large businesses, the PBM business, they'll go to the General Motors of this world and they're saying, you guys are spending, let's say, $1 billion on your health plan. We'll manage this for you and bring your cost down by $100 million. So, General Motors wins. And then they can direct some of that business to the CVS stores because they're vertically integrated. GM, so the company wins in the first place. More things get diverted to a CVS, for example, and the like. And so that vertical integration provides a lot of synergies, and which we're already seeing happening. And so they've become a completely different model than a pure Walgreens. And it's showing up in the profit growth. And when you buy CVS, we're looking for 10% annualized earnings growth over the next few years, and you're paying about 10 or 11 times earnings with the dividend growing. So it's a pretty attractive company to buy. and benefiting from a whole bunch of different areas. So Walgreens is figuring out ways to catch up.
But the PBM business, so pharmacy benefit manager, back in the day, well over a decade ago, maybe two now, they were their own category within the healthcare sector, PBMs, owning PBMs. There was a bit of controversy certainly surrounding them. So I don't know if you had looked at that in the past and can speak to why there was the controversy and is there any today?
So first of all, one of the controversies was, are patients getting, treated in the best way if the goal is to reduce healthcare costs? So I think that is was a valid question to be asked. In the US, it was a little different because patients were forced, instead of using name brand drugs, to use generics. Really not a big deal in Canada. That's been going on for years. But that's always been part of the issue. Has been our patients getting treated the best? I mean, the reality is every company is looking to cut back on their healthcare plans. Expenses are mushrooming. That being said, the system seems to be working much better. It's quite regulated as well as the rest of the healthcare sector is. But and there's also fewer PBM players around today because of acquisitions and the like. So it's become more of an oligopoly type business. But I think the real juice in the business is the vertical integration where you can use the pharmacy side, the PBM side, and pull it all together. And it's that combination which is really driving the earnings growth for a CVS. It's not the pure pharmacy business, which is a tough business.
Yeah, and that's important, an important distinction in terms of if you're going to look at any of these companies, these Walgreenses of the world. Staying with healthcare for a second as well, Becton Dickinson is another name. Remind us their business and why you like it.
Sure, I'll tell you why we like it and why they suffered during COVID. Becton Dickinson, why we like it is 90% of their products are disposable. So everything from catheters, testing equipment, it's all, we love that because healthcare is just growing because of the aging population. And if you're in the disposables business, then, people getting tested, all going to hospitals, operations, all the rest of it just means more demand. What happened during COVID and why Becton Dickinson suffered somewhat is because elective surgeries, of course, fell dramatically for obvious reasons. COVID patients taking up more beds. So Becton Dickinson's earnings suffered a bit for sure last year. All those people who want to get, knee replacements, hip replacements, et cetera, had to delay their surgeries. So that being said, we should see a big bump in Becton Dickinson's earnings just for catch up over 21 and 22. But they've done a great job in folding in acquisitions. They've got great margins. And, in the areas that they are active, where their businesses are, those verticals, there aren't a whole bunch of competition at their level. Distribution is a huge thing in that business. And so it's really the mega players. Hospital doesn't want to have 27 different suppliers for catheters and the like. They'd rather buy them from one main supplier. So Becton Dickinson, I wouldn't call it an incredibly cheap stock on a earnings multiple basis, but it's certainly going to deliver really good earnings growth, and we find it for us a core holding.
Many years ago, Lorne, when I was at Goldman, I was on the deal of Thermo Fisher Scientific, which has been a stellar company and a stellar stock. We were offering it. It was follow-on offering, $24.50. I think it was $24.50. That's always because we had to that was in the range. We did change it a little bit, but it was such an incredible company. And because it was during the .com boom, a lot of institutional investors were not interested, but I was able to get a good order from a special situations portfolio manager, if you can believe it. And now that company, so it's in the same line as Becton Dickinson. And I personally didn't buy it. I certainly wish I had. What's the difference between a Thermo and a Becton?
I think Thermo is involved in some more specialized areas. Becton Dickinson, I would say, is Not that they're not specialized, because everything in that field is somewhat specialized, but I'd say they're less of an R&D type company, and versus a Thermo Fisher, which would be more of a specialized R&D type. Is Becton Dickinson making cutting edge products? They're making more mass used products in hospitals.
Yeah, so that's the way to think about it. Both companies have its mass use, and I think it's interesting. Yeah, and of things that you would never necessarily think about, and these are a couple leaders in it. It's incredible. What's the other? It sounds like it may be a smaller cap healthcare company. Yeah.
So Viatris is the cheapest stock in our portfolio, and there is some risk to it. No one's heard of Viatris because the company was the merger between Mylan Labs, the generic drug company, this was in November, and the Upjohn division that was spun out of Pfizer. So those two companies merged in November. So this is a brand new enterprise, if you will. If you look at the valuation, maybe it's 5 or 6 times earnings, so it's incredibly cheap. They disappointed the street in the last quarter, the December quarter, and so the stock is trading for next to nothing. They are going to pay out a chunk of their free cash flow in the form of dividends. So we think that'll happen in the second quarter. So by July, there'll be a dividend yield attached to it of maybe 3 to 4%. And at the valuation that it's trading at, not very much has to go right. It's the Upjohn folk that are running this company, did a really good job at Pfizer. This company needs good management, but as we say, they're a well-capitalized business. They've got some good franchises. If they get to the point of having average management do an average job, maybe this will trade at 9 or 10 times earnings, which would provide a big bump in the share price. So we don't need much to go right with it. But if you do look at the Wall Street research, they're all saying we want to sit on the sidelines and wait for a few quarters and see what happens with this business. But the valuation we're paying with tons of free cash flow yield is like 15%. So it's cheap, but it has some risk.
Yeah, interesting. But just to familiarize ourselves with it, and I do remember the spin out of J&J. I'd forgotten about that in Mylan Labs. What are the different business verticals that they're in?
So Mylan was a generics company, so they have the generic side. Upjohn has some very mature drugs, and so they're built. They've got a pipeline as well. Pipelines are always risky. So in our analysis, we're giving no value really to the pipeline. We're looking at the cash flow from the generic side and the existing drugs, and saying, okay, what is this company worth? No, we don't have a 15 times earnings, but do we think you can get to 9 times earnings, which would be a 50% increase in share price? That we do. And with a 3 to 4% dividend yield attached to it, it looks like a compelling buy. But, a company like this could disappoint again over the next couple of quarters. The stock could get cheaper still. That's why I say there is some risk. There's no financial risk. There's no balance sheet issue here. It's a free cash flower. But could be choppy waters for the next few quarters.
Okay. And we talked a little bit about your interest in owning financials, specifically some of the Canadian banks, but y'all and insurance companies. And on that front, you have 2 U.S. companies to talk about, Allstate on the insurance front, and then also Goldman. Sure.
So, listen, Allstate is the premier property casualty company in North America. They are pure property casualty. They do it better than anyone else. And one thing I will say about them, we always read about companies buying back stock. And, sometimes their share count doesn't go down very much because they issue a bunch of options and they're spending tons of money and, share counts remain the same. Allstate's share count, Catherine, is less than 50% of what it was 15 years ago. So this company is using its free cash flow. They're creating value for shareholders. There's annual dividend growth. They have very strong margins. And the whole industry, by the way, is benefiting from this is one thing that is going on, which is drivers and homeowners are not making small claims because they're worried that their rates are going to go up. So this is a trend that is, we all understand it because I had a kid hit the back of my car and I didn't make a claim as an example. So Allstate's benefiting from that. And also more and more companies are using apps and the like to measure drivers and to get a better idea of how to price their product. So Allstate, 12 times earnings, phenomenal, double-digit earnings growth, steady dividend growth is compelling. Goldman Sachs has been an underperformer up until maybe a year ago or so. The evil geniuses, as I call them. But Goldman is, first of all, every financial benefiting from a steepening yield curve. As the Fed takes their foot off the gas pedal, we expect to see long-term yields continue to rise somewhat. And that steepening yield curve is really bullish for financial companies' margins, really bullish for Goldman's margins. And Goldman has just done a spectacular job continuing on the investment banking side. Even the recent scandal we saw, not scandal, the issue with that, family office fellow, Archipagos, or whatever his name is.
Yeah.
Goldman and Morgan Stanley, got out of that thing before Credit Suisse and others. So, they did not take a significant loss. We also own Morgan Stanley as well. So you have a chance to buy these businesses at like 12 times earnings or so, which is, in any market, a pretty decent valuation for a world-class business.
Mm-hmm. And just to go back for a second, what's the other UK company that you like? You mentioned Redrow and the home builders.
Redrow is the largest home builder.
Okay.
The other one is Compass, which is in a business which, they supply food to food courts, as an example. Well, who the heck is going to a food court? Okay. But also to hospitals, prisons, and the like. So the stock had been a laggard. They had to raise more equity probably over the summertime. But they are, best in class in Europe. They're a UK-based operation, but best in class in Europe. They've done a phenomenal job at acquiring, similar type companies, improving margins. And for us, we look at this company and we see high single-digit earnings growth at a pretty compelling valuation, and not a lot of competition. And so that's one of our drivers there.
Okay. And Lorne, I just because they're international, I want to just make sure I've got the right tickers from you. I don't know if are they ADRs, are you buying on their own exchange?
No, we're actually buying these two companies in London.
Okay. All right. So that's what people have to do. Lorne, let's take a few viewer questions right now. For Lorne, since I know he has a value yield bent in a lot of his analysis, does he see retail REIT exposure in Canada as good value here, RioCan as well as Smart Centers?
So I have to say, on the office building and retail side, we would be pretty cautious. We don't have exposure. Listen, I'm in a large office building in Montreal. We're in a building in Toronto as well. Everyone we speak to can't wait for their leases to come up so they can, take less space going forward. So office is going to be a really tough place to be for the next number of years. Retail, has been badly damaged by COVID, as if it weren't badly damaged enough before COVID. So again, we expect to see, as leases come up, some decline in those areas. Not to say there might not be smart operators, but just, you'll be buying into a tough industry. So just be careful. Even on the residential side, the apartment side, we see value in a company like, CAPREIT, which Canadian Apartment Real Estate Investment Trust. But even that sector is being hit because no one's traveling. So all these investors who bought condos in Toronto and elsewhere to put them up on Airbnb and for student housing are now dumping them on the long-term rental market because there's no one in them. And so that's why, Toronto condo rental prices are down sharply. But for us, that's more of a temporary phenomenon. But I have to say, a lot of the REITs are back to where they, trading at near their all-time highs. So it's a tough space to find value in an environment which is really undergoing change.
Okay. Next question is from Rick in BC. I love this. My question is about Enbridge. I hold this stock in my Canadian portfolio and will long term. I love the dividend performance. What are your thoughts? Thanks.
So we own Enbridge in our Canadian dividend strategy. One thing we say, it's becoming somewhat apparent that it's going to be really tough to get another pipeline built in North America for the obvious environmental reasons, NIMBY reasons. I see in Michigan, the governor is, shutting down, part of a pipeline. It's just, so the existing pipelines are going to be able to raise their rates over time. Unfortunately, for Canadian oil and gas producers, they are stuck. These are the only outlets for them. And so, Enbridge is doing something which we're happy about, which is increasing their dividend at a slower rate and paying down some debt. So, we prefer companies that don't have a lot of debt. And so we're happy with that strategy at Enbridge because we think it will create a more sustainable business over time. So Enbridge and TransCanada, TCE, are benefiting from the fact that there is just no one can build a darn pipeline. And so shippers are forced to use them, and they'll be raising their rates over time.
And therefore likely passing that on to the consumer.
Exactly.
Yeah. People don't sometimes realize that the lack of pipeline capacity and the ability to build will absolutely hit their pocketbook. We'll see that happen.
Absolutely.
Yeah. The other day, what?
At the end of the day, if you look at actually the price of if you get natural, if you're heated by natural gas, the actual commodity price of natural gas is a tiny price of what you are paying. The bulk of what you're paying is the transportation cost.
Yes, you're 100% right. Look at your bill, right? Yeah. I think I know the answer to this, but what's your thought on Whitecap Resources? I don't think you probably invest there, or Imperial Oil.
So we don't actually hold any oil and gas producers in our firm. And my comment is, I think if we never buy another oil and gas producer or mining stock for the rest of my life, I don't think it'll impact my net worth. I just think do we want to spend our time trying to guess where the price of oil or gas is going to go, or gold for that matter? Or would we rather buy companies which are growing over time, whose earnings and dividends will grow over time, who have control over the prices they charge? And that's kind of the way, if we look at Barrick Gold, just as an example, I'm not picking on them, but they're like the largest gold producer around. Mm-hmm. Barrick Gold share price is roughly the same share price as it was 30 years ago. So there's been no shareholder value created. Compare that to Canadian bank stocks, great consumer companies. I mean, it's the answer is obvious. Yes, if you buy it low, sell it high, and keep on doing it, make money, but that's true for anything. These are just tough places to be.
Mm-hmm. I was wondering, though, when you think about some energy companies like Exxon, I personally bought Exxon because I liked the dividend yield. I think I bought it over 8%. I figure they're going to be around, especially, with the lack of capacity in the energy sector as well. So that was the reason why I kind of stepped in. So I thought maybe you'd go there, but no.
No, we're not there. But I will say, when people ask me for a renewable company, some of the largest investors in renewables are the big oil and gas companies.
Yeah.
Royal Dutch Shell, Total BP. I mean, they understand that 30 years from now, oil demand will look different than it does today, and they're repositioning themselves. And so they have, they're spending billions of dollars on renewables, renewable technology. They're investing in all kinds of businesses. They're becoming mini private equity venture capital companies because they see the future. So, I mean, listen, a lot of these are well-run companies like an Exxon. They're not sitting still. I have to say, if I would be investing in that sector, I'd be investing in those types of businesses because they have the financial capacity to make those investments today.
Mm-hmm. Makes sense.
They're not in reactive mode all the time.
Yeah. Lorne, we'll wrap it up here, but before I let you go, I'm asking, I think, everybody who I interview this question, regardless of their focus or sector. What's your take on cryptocurrencies and Bitcoin and what have you?
So first of all, Catherine, I was afraid you would ask me this question.
Oh, no.
But I'm teasing when I say that. The reality is I've never heard anyone explain why crypto would be attractive unless you are a drug dealer or someone who wants to get paid and hide money from the government. If I ask any business, would you like to get paid next month in a currency for which you don't know what the value will be? No one has answered that question, yes. It reminds me, if I can just end on this, that Peter Lynch, the great Fidelity fund manager back in the 80s and 90s, said if someone went in to sell him an idea, he would take out his trusty egg timer and turn it over. And if you couldn't explain the idea in 3 minutes, he'd throw you out of his office because it's too complicated. I've never heard anyone be able to explain cryptocurrency to me in 3 minutes or an hour. And, you know, the old maxim, if you don't understand it, you better not invest in it. So I'll leave it to people who are smarter than I am.
That's a perfect way to end it. And I love the idea of a 3-minute egg timer.
Peter Lynch was a pretty bright guy.
Yeah, we certainly do know that, don't we? Lorne, great to see you and speak with you. Appreciate your time and everything.
Great to spend time with you as well.
Thank you. We'll do it again. I hope, and God willing. All right.
Thanks so much, Catherine.
Thank you. We'll see you later.